What's going on, YouTube? Stocks by the numbers. Trying to do this very quickly here because the company has begun to run, and I forgot to look at stock charts when I did the recording before, and the video was over 30 minutes, and I didn't even get the stock chart. So I'm going to try to speak really quick, so stay with me here, all right? Shout out to Manila Boy in the Discord. He wanted a special request. Analytical view here of Peabody Energy Corporation, ticker symbol BTU, listed here on the New York Stock Exchange. Company right now is running here with the rest of the market in the last hour of trading up to 1990, down about 42 cents, roughly 2% here on the day. And I just want to show you guys, this is a 5-year chart going all the way back to 2019. And you can see, look at how it bounced below this trend line. This trend line right here, roughly like 1980, 1973 or something, basically where we're sitting right now. And you can see, if we zoom in here, you can see, look at the multiple resistances off the trend line, and then it breaks all the way down. The stock got to 80 cents and then rallied to almost $20 in less than a 12-month period. So anyone who was involved with this, you made roughly a 2,000% return. Congratulations to you. Hats off to you, because you knew that you were buying, like I always say, a healthy, distressed company at a significant discount. That's what we're looking for. That's the Buffett method. And again, you can see multiple rejections here and here coming off this trend line, fighting to get above it. And look at this big oval I drew here. Multiple bounces, multiple. We broke, and then we got right back above, bouncing, coming up, coming down, bouncing. And boom, we're right back at it now. So that's why, in my opinion, there's a very, very key level. And of course, the stock could go down before it goes higher. However, based on these technicals here that we're looking at, it technically should bounce from here. We pull up a 3-month chart, and I just want to show you, going back to, looks like the beginning, first half of April here. You can see the stock has basically been in this downward channel since then. However, during this period, the company has beat earnings on both the top and bottom line, and of course, reinstated the dividend, paying to shareholders roughly 7.5%. So, in my opinion, seems like they're doing some good things. And again, you can see, look at these candles here. They were bouncing around, trying to fight to get above the trend line, and now the stock closed on that candle above this trend line of whatever, 1973 or whatever the heck we're at, and boom, now the stock's trading at 1990. Of course, the Dow has risen, roughly 100 points, during this time frame. So, in my opinion, excuse me, this is basically a descending wedge, which we kind of keep seeing, and we should technically hit the apex here and bounce out. But again, the apex, if we come down, we're looking at what, like May 31st, June 1st. So this stock could really trade sideways for about a week and just bounce off this trend line and stay right around here, and then have its breakout up into the 20s. But in my opinion, it does seem like a key level. And again, it went down today. 1958, but of course bounced up and got back above those trend lines. So I really don't think there's going to be much downside, and you probably, in my opinion, have more potential for upside as opposed to downside. But technically, it really should bounce off of that and climb back into the low 20s. If we pull back that 5-year chart, no, 5-year chart, 1-year chart, yeah, 1-year chart, you can see again pulling back into the descending wedge, bouncing around here, coming off of 2 beats in a row, coming off of 3 beats in a row, right? But the company was flat and then began to pull back. So that's why, in my opinion, undervalued, probably going to break out and bounce out. We're looking at a market cap $2.877 billion. That's embarrassing. Dividend yielding about 1.5% for you to own the stock. PE less than 2. Company's earning almost $12 a share. So in my opinion, the company's absolutely just rocking and rolling right now. You can see the revenue took a massive hit, going from $5.5 billion down to sub $3 billion in 2020, and then immediately rebounding up to $3.5 and back up to $5.5 billion. But look at this. Look at the profit margin, almost 24%. Go back to 2018 when they brought in roughly $5.5 billion in revenue. Look at the profit margin, 11.6%. So that's why the company has significantly lower cost and increased profitability. We're looking at the forecast here. You can see average 1-year price target north of $30, which of course is north of a 50% move here. We switch over to the forecast, and you can see 5 analysts, 1-year price target, Peabody Energy Corporation, max estimate of $34, min estimate $29. So the lowest analyst expectation is roughly 50% higher than where the stock is currently trading right now. Ridiculous. 3 strong buys, 2 holds. What do I say? If they basically all come out and say it's a buy or it's a hold, chances are it's probably a buy. We switch over here to the forecast, though, and you can see they're expecting some sort of rocky terrain that the company is going to run into here for 2023, estimating $6.29 a share, dropping to $3.67 and then $1.72. Now, these forecasts, of course, do look negative, but like I always say, this is just a forecast. This is just a prediction. So until we hit 2024 and they post an EPS drop like this, it doesn't matter. And same thing with 2025. And they show the revenue dropping, again, going to north of $5 billion here for this year of 23, and then dropping to 4.2 and then 3.8. Now, obviously, this does potentially raise a red flag, but like I always say, it doesn't happen until it happens, right? We can all forecast. I mean, you and I could start a company tomorrow, and we can forecast, oh yeah, 12 months from now, we're going to bring in, $3.5 million for revenue. It's like, wow, that sounds great. But again, it's just a forecast. And until the year ends and you prove on paper that you brought in that much revenue, all of this is nonsense. Because if you tell me you're going to make $3 or $4 million and then your company only brings in, 300,000, it's like, your forecast was dismal. You have no idea what you're talking about. And now, because you hyped me up and seriously under-delivered, I'm even more pissed off. And now I'm betting even heavier against your stock, right? Screw you. But anyway, this is something to keep an eye on. But overall, as we see here, 3 out of the last 6-year beats on the EPS side and 4 of the last 6-year beats on the revenue side, 4 of the last 5 years if you go back just looking from 2018. So as of late, the company seems to be rocking and rolling here. I really will say that. Switching over here to the financials very quickly. Again, as you see here, decent beats there. And again, the company was paying a dividend back in 2018, 2019, and just recently reinstated the dividend payouts back to shareholders, roughly 7.5 cents per share. Again, only yielding about 1.5% dividend yield. But again, you can see even back at 48 cents, it was even with the dividend yield. And of course, dividend went up, stock went down, so then the dividend yield spiked up to about 6%, and then the shit hit the fan 2020, and the company stopped paying out the dividend, but again, has begun paying out their dividend. Last ex-date, as you see here, May 9th, last payment almost 8 cents a share. So that's why the company is getting back into the dividend payment, which of course is a very good sign. And of course, look at the red bar here, the debt, $1.37 billion. 1.39, 1.61. Oh shit, not looking good. Bouncing off the pandemic. 1.18, 360 million. That is a phenomenal U-turn taking down the debt. I will say that. This is what you want to see, technically, in a very healthy company. More importantly, look at the free cash flow and cash equivalents here. 129 million cash flow, 700 million cash equivalents. 700 million free cash flow, 950 million cash equivalents, 1.5 billion cash flow, 1.3 billion cash and equivalents. So the debt is decreasing, the liquidity and positive cash flow is increasing, right? These are all very, very good signs. If you add up your assets and your liabilities, you're sitting at about 5.5 billion in assets. And what's that, like 2.3 billion in liabilities? So maybe close to about a 2.5 to 1 ratio, which of course you always want assets to outweigh liabilities. And also switching over here to the income statement, you can see again revenue was maintaining about 4 to 5 billion, and then took a big hit there in 2020, and has since been rebounding. And honestly, pretty quickly got back to where they were. So that's why again you got to give credit where credit's due. Look at the cost of goods sold, though. Back in 2016, 17, 18, look at this. Well over 4 billion, almost 5 billion. And at times, excuse me, and at times you can see, look, almost even, slightly outweighing, almost even, cost of goods sold outweighing revenue, and then slightly back above, and now look at this, cost of goods sold 3.6 billion or 5.5 billion. Look at the last time they brought it in, 5.5 billion, 4.67, 4.8. So the company has regained that high of yearly revenue, but has lowered the cost of goods sold by roughly 20-25%, which is absolutely phenomenal. And of course, revenue minus cost of goods sold yields gross profit, which, as you see here, 1.8 to 1.9 billion currently, and this is significantly higher than it has been throughout the years. Even the operating expenses, look at this, was north of 200 million, maintained 140, 150 million, then drops to sub 100 million, now sub 90 million. So this company, that's why I'm saying this company has a lot of these fundamental metrics really, really working out in their favor. And I'm seeing a heck of a lot more positives than negatives here. Of course, gross profit minus operating expenses yields operating income. And again, operating income right now, 1.7, 1.8 billion, significantly higher than where it has been throughout all of these years. This is why I really am liking this stock right here. I really have to be honest here. We switch over to the balance sheet. We're just looking at a couple of these things. And look at the assets and liabilities almost in line here. Then they break out to like a 2-to-1 ratio and almost back to break even, and have since, again, we looked at this before, again, assets now sitting at roughly 5.6 billion, and the total liabilities are down to 2.3 billion, just significantly decreasing the liabilities year over year, basically every year straight, going all the way back to 2016. So yes, assets have been bouncing around. However, the company getting rid of certain assets and then reacquiring newer or different assets, as we can see, is heavily working out in their favor, as now they are rebounding the asset value and have significantly lowered their liabilities year over year. And of course, we looked at the debt as well, consistently decreasing. Equity is assets minus liabilities, yields equity, again, almost back up to the highs it was back in 2017 and 18. Company is still holding some debt on the balance sheet, but look at the book value per share. This is what I'm saying. So if the company had to go out of business, liquidate everything in their name, and give it back to shareholders, you're getting paid roughly $22.50 per share. Stock right now, $19.80, right? Think about that. And then, of course, the cash flow, as we've seen, has been bouncing around. Cash from operating activities was 1.78 for last year of 22, now currently sitting at $2.5 billion, which is the highest it's been going all the way back to 2016. The cash from investing activities seems to be remaining negative, sitting right here at about minus $800 million. You know, yeah, definitely not a positive. However, not the worst it's been. And cash from financing, same thing. As you see here, 2018 was a pretty rough year for the stock and for the company overall. But, you know, these really aren't the biggest indicators. But the cash flow, as we looked before, free cash flow, cash and equivalents, significantly climbing year over year, basically for the last 3 years in a row, going back to the pandemic shit hitting the fan situation. Excuse me. I'm talking myself out of air here because, again, I tried to make this video before, and it was over 30 minutes long, and I forgot to look at a lot of metrics, so I'm really just trying to just consolidate this. Price to earnings ratio, again, the company was having a negative EPS. If you're not earning positive earnings per share, there is no price to earnings ratio. But as you see here, sitting sub 2, basically the lowest it's been anytime they've been EPS positive. The price to sales was significantly lower. It was even much higher than where it is now. Not really the main indicator I would use here. Price to cash flow, we saw cash flow consistently increasing, and right now they're only trading 1.3 times cash flow. And again, book value, it was significantly lower. At times, it did get above 1 time book value, but now sitting 0.85 times book value. That's why I'm saying right now in 1980, the company has a book value of $22.50. The enterprise value, which is what another company would pay, again, not the main indicator I would use. Yes, it could be an interesting indicator. However, we saw with companies like Palantir and some other overvalued tech stocks that when the stock absolutely exploded, so did the enterprise value. And all of a sudden, the enterprise value was 40, 50, 60 billion. And in the last couple of years, since the stocks have come back down to earth, all of a sudden the enterprise value is like 5 billion, 6 billion, right? So a couple of years ago, the company was worth 50, 60 billion. But now, with revenue probably increasing from several years ago on any company, again, speaking in generalities, but with revenue increasing over the years, now you're telling me enterprise value went from 50 billion down to 5 billion. Okay, so, you would now pay 90% less than you would have back then. You know what I'm saying? So that's why. I know a lot of these metrics are here, but they're really not the best indicators to use. Coming down here on the profitability side, some of these numbers have decreased slightly from the year before, but still maintaining pretty healthy levels here. The return on assets was significantly negative here with the equity and invested capital, and they have all significantly increased year over year for the last 3 years in a row. The gross margin percentage was negative here. This is 2020. And you can see explodes back up to double digits and then basically doubles the year after up to north of 33%, has since pulled back to 26%. Is that technically a negative? Yeah. But at the same time, looking where the company came from, right? So look at this. Minus these highs of last year, this gross margin percentage is the highest it has been going all the way back to 2016, right? So technically, yeah, it did go down year over year, but at the same time, it's the best it's freaking been in, 5, 7, 10 years or whatever. So that's why I'm saying something like that slight decrease there, I don't view that as a red flag at all. Operating margin, basically same thing, was negative, exploded to double digits, north of 31.5%. Now still sitting north of 24%. Again, minus this last year, the highest it has been, going all the way back to 2016. So that's why they're beating the company up, and it might not be justified. EBITDA, once again, earnings before interest, taxes, depreciation, amortization, was, after all of these years, 4 years in a row, maintaining healthy numbers, dips down to single digits and then immediately rebounds to 24.2%, almost back to highs, and then north of 38.25% on the EBITDA margin, the highest going all the way back to 2016, since pulled back to north of 31.6%, again, the highest minus the last year it has been since 2016. Net margin percentage, basically same thing. Was single digits, climbed up to double digits, drops down to negative. Massive drop here in profitability in 2020, and then began to rebound back into single digits, back into double digits, above the 20s here, the highest it's been since 2016, and has since pulled back roughly 10% from 23.7 to 21.3. However, this again is the highest it has been, going all the way back to 2016 minus last year. But I also wanted to show you this too, right? The asset turnover. Now, we spoke about this again, just a quick update here for you. Asset turnover can be used to measure the effectiveness with which a company uses its assets to generate income. The higher it is, the more efficient the company is, since higher ratios mean that the company generates more income per dollar of assets. Well, look at this. Increased 3 years in a row. Had a pullback here going into 19 and 20, as we saw. That was a speed bump for the stock, for the company, and then climbed back up to 0.72, the highest it has been since 2016, and then another one above $1, and then another one, now not $1, above 1, excuse me, and now currently sitting at 1.06. So we're at the highest levels here on the asset turnover, going all the way back to 2016, and that's why when we looked. Right, the asset turnover, this is what I'm saying. As we looked here, where are the assets? Here we go. So again, the assets dipped down, but again, they were basically 1 in 1, and now they've been climbing back up here to where they were, but again, the liabilities have been significantly decreasing. So the company is taking care of what they're liable for. They're trying to lower debt. They're increasing cash flow. They're beginning to increase the assets on their balance sheet again. That's why asset turnover has been increasing year over year for the last 2 or 3 years, right? So this is all lining up, in my opinion, for something positive here. And again, you can see dividends paid out in 2018, 2019, and recently started paying out their dividend again. We looked at the forecast, I believe, again, looks a little wishy-washy. They do expect lower forecast. However, again, like I say, this means nothing until it actually happens. Revenue bouncing in sporadic. Again, a lot of these sectors, basically rebounded with some of these higher numbers. And, of course, we have some other sectors that have kind of completely fallen off. But overall, like I say, numbers don't lie. And the company technically beat earnings 3 quarters in a row. And I want to show you also, B. Riley cuts Peabody's price target to 29 from 39, keeps buy rating. Yeah, they lowered the price target roughly 25%. However, their price target is still about 50% higher than where the stock is currently trading. And even though they felt it might go lower than where they first anticipated, they're still saying it is a buy. And more importantly, April 27th, over here, the company comes out, beats on the top and bottom lines, and announces $1 billion share repurchase authorization. That is why all of these things, in my opinion, are basically lining up for like a positive perfect storm that here within the next week or so, we really should have a pop out here off of this trend line, out of this descending wedge, and we should get back to the low, if not mid-20s here within the next couple of weeks or month or two. But again, that's just my opinion. Switching over here to stock charts very quickly. This is what I forgot in the last video. That's why I had to record it. But overall, you can see the stock has been slipping again since like that first half of April. And this whole rally down here is our descending wedge that we pointed out. The stock has been riding along the bottom Bollinger Band. The MACD has been seriously slipping. This is why I'm saying if it's ready to pop out here, this MACD is going to curl, and then it's going to eventually cross. That's going to add to the rally, and that's why getting back here, the 50-day moving average, 23.68, definitely doable. Top Bollinger Band here, doable. And again, with the MACD crossing and RSI rising back up, this 200-day moving average, 25.68, really shouldn't be a problem in my opinion. You can see also the bounces right there off of the moving average. So the stock for a while wanted to maintain that level and then broke in April. But since then, the company has been making some good announcements. Again, beating earnings. Everyone's maintaining a buy rating. Lowest price target, $29. And $1 billion share repurchase program. So again, MACD ready to curl, in my opinion. And of course, look at the RSI now, sitting at 27.3. And basically, going back here, even recently, when it dipped here below 30, you can see the little pop there to get back up. And now we're dipped back below 30. That's why I'm saying I really do feel that a rise is due. And even going back here earlier throughout the year, you can see it never really broke below 30 and bounced off that level. So that's why, in my opinion, I do think it's going to happen sooner than later. Switching over here on the weekly, you can see random ad. Basically, same thing. RSI has been sliding down. Again, 35 on the weekly. So that's why I'm saying it could take maybe another couple of days where it remains flat, stays in that descending wedge if they want to bring the RSI down here. But as we looked on the daily, it's not right now sitting at 27, the lowest it's been in months. So that's why, in my opinion, it really should rise before it drops down. The MACD, again, has been significantly selling off here for the last couple of, basically since the ball dropped. So that's why, you know, it's like a baseball analogy, right? If someone goes like 0 for 19, like throughout an entire week of all these games, what do they say? They say that that batter, as a hitter, he's due. Right? That's what they say. Oh, you're due. You're due. Because the average baseball player hits, maybe like between like 200-300 batting average. That's only getting a hit 20 to 30% of the time. A lot of people don't realize that. It's one of the most difficult things in the world to do is hit a baseball. Now, again, of course, we're going down a rabbit hole, but going back to the initial metaphor, you can appreciate where I'm going. The stock is due, in my opinion. And that's why, for it to continue to slide all the way down here into the low teens, not only do I think it would be a drastic overreaction, in my opinion, but I would be buying every single step of the way if I had the liquidity. Because like we always say, if we like it at 19 3/4, we would love it down at 15, 14, or 13. Are you kidding? We're basically looking at a $30 stock for sub 20, and now you're telling me, forget about buying it at 19. I could buy even more shares down at 15 and 14? Thanks for the handout, Wall Street. I appreciate it. Right? So that's why, again, in my opinion, I really do believe we have much, much more positives lining up for this stock as opposed to negatives. And another shout out to Manila Boy in the Discord who said, hey, why don't you take a look at BTU? I think it looks pretty good. So I'm going to end it there. This is why I tell people to join the Discord, because it is much easier for me to immediately reply to you in a Discord, which is instantaneous, or even within a couple of minutes if you leave a comment on a video somewhere, if you want to ask me a question. Because when I make these videos, I have to take 10, 20, 30 minutes to record them, and then it takes like another 30 minutes sometimes to upload it to YouTube. It has to do the copyright check. It has to process the video in standard def and into high def as well. So sometimes, you know, it may take 30, 40 minutes just to upload like a 6 or 7 minute video. And we know how quick the market moves, right? So imagine I was trying to make a video here for a day trade. Oh, it's descending wedge is about to pop out, and like as the video is uploading, the stock is breaking out. And then when I upload the video, what would you say? You would say, "Wow, great call, great analysis." Problem is, it was about 20, 30 minutes too late. I could have used this like an hour ago. right? So that's why if you're able to join the Discord, if you don't like Discord, don't want to use Discord, obviously we can communicate again in the comments section. But just throwing it out there to just kind of streamline my analyses on a lot of these stocks, and of course any potential short-term recommendations, any patterns I see setting up, I'll try to let you guys know in the Discord. You can ask people in the Discord or even in the comments section with anyone who's in Discord. You know, the last couple of days, I think we went like 4 for 4, calling out some puts on companies like DraftKings, the Dow Jones overall, and then Verizon was setting up. It looked like the stock was about to rally upward, so I called out to buy calls on Verizon in the Discord, and then yesterday we see, boom, stock had like a 2% pop, and everyone's just posting their testimonials in the Discord. You know, thank you so much. I made 200%. I made 240%. The options were up almost 300%. Great call. And that's what I'm saying. Something quick like that, a quick trade, sometimes you just don't have the opportunity to make a video and wait for it to upload. And then, of course, we have to wait for you to get the notification or have it appear on your YouTube homepage and, you know, as a suggested video. And then that's what I mean. By the time you get to it, you may have missed a trade, right? So we have to be quicker and try to streamline, you know, a lot of these situations here. So just an idea for you out there to jump in the Discord, but it's entirely your own prerogative. And I'm going to leave it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Just like everyone on YouTube says, like the video, thumbs up, algorithm helps me get more eyes on the channel. Subscribe to the channel. It means a lot to me. Watching the community grow. I actually think I have a phenomenal ratio of people subscribed, not subscribed, viewing my videos. And I just want to tell you guys how grateful I am. I love seeing that even though it's a slow grind to build up the community, we're doing better than expected, and we're coming in with above average ratios when compared to a lot of other channels. Because even channels that have a couple of 100,000 or a couple of million subs, they'll post that like 92% of all viewers aren't sub to the channel. We have kind of the opposite thing going on. I believe I have like only like 82%, I think, of viewers watching my videos that aren't subbed. So, right? So you guys coming in watching the videos, you're understanding what I can potentially bring to the table. You're seeing the value not only in me personally, but of course in the way I break down my analysis, and you see potential moving forward that, you know, we can help each other out here, and I could make you a couple of bucks down the road. So I really want to, you know, just give my thanks to all of you who just took a moment to push the subscribe button. I do wish more people would, because I feel that I have a heck of a lot more to offer than a lot of these other YouTube quote-unquote stock hobbyists who are now struggling under this Biden administration. So what did they do? They basically started making videos talking about nonsense, or just updating you on stocks that hit new 52-week lows, but not giving you any analysis on it, which is basically a waste of your time. And of course, what do they also do? Oh, look at my portfolio. Look at my positions. What do you think? Oh, today I'm analyzing this stock. Today I'm analyzing that stock. Why'd you pick those stocks? Oh, those are the ones I'm holding in my portfolio. Oh, okay. So you're selfishly making a video really for yourself to try to get more of the public on your side to buy that stock, to pump it up for you, because you have no idea what you're doing and you've been losing money. Right? So that's what I'm saying. You got to put on the blinders, you got to see through all the bullshit, and you have to find the communities and the people who are really going to teach you knowledge and help you out with trades and investments moving forward. And I really do believe that that's what I bring to the table. But again, that's just my opinion. If you like what I have to say, like the video, sub up. If you don't, call me a schmuck in the comments. I don't care. I love to have a little back and forth sometimes. But yeah, I'm going to leave it there. So, Stocks by the Numbers, thanks for stopping by. But like I always say, moving forward, I understand that markets are rocky and volatile and uncertain. So I want to wish everyone success. I hope everyone makes a couple of dollars. Thanks for giving me a few moments of your time. Have a good week. God bless.